in 1626, there were some Dutch settlers in what we know today as the island of Manhattan. And actually the Indian name for it is Mannahatta. They kind of tweaked it to Manhattan. And the Dutch wanted to buy the island from the Native Americans. And they had a guy, their negotiator, Peter Minuit, who was a trader. So they sent Peter to make a deal with the Indians, and the deal was done for 60 guilders, which is about $24 at the time. So for basically $24, the Indians handed over the rights to the island of Manhattan to the Dutch. And when people hear that, they say, well, the Indians kind of got taken, because you look at it was very prime land and great natural harbors and all of that. If the Indians had a, let's say, trust officer or investment manager who was going to take this $24 and invest it for the benefit of the tribe, and let's say the guy wasn't that great, but could do maybe 7% a year. We have something known as the rule of 72. Some of you might be familiar with it. Maybe who's familiar with the rule of 72? We have a couple of folks. So the rule of 72 is a very easy way mentally to understand how long it takes for money to double. So if I have a 7% rate of return, I can just do 72 divided by 7. It's approximately 10. So you would just say it's 10 years. And if I were, for example, getting a 10% return, if I do 72 divided by 10, it's 7. So it works pretty well for a pretty large range of percentages. So it's a good back of the envelope way to understand, what different interest rates will do in terms of, building wealth over time. So if the Indians were getting a 7% rate of return, every 10 years that money would double, right? So 1636 it would be $48, and 1646 it'd be $96, and we'd keep going, right? Now, if you do 10 doubles, that's 2 to the power of 10, right? So 10 doubles would take 100 years. So every 10 years we're doubling. If you go for 100 years, that becomes 2 to the power of 10, and 2 to the power of 10 is 1024. So again, because we want to keep the math simple, just throw away the 24. So basically, 10 doubles at 7% means whatever you started with, you would have 1,000 times that. So if you start with $24 in 1626, then by 1726, it's 24,000. It's 1,000x because of that 7%. And 1826, it's 24 million. And 1926, it's 24 billion. And 2026, it's 24 trillion. And now we are 2023, we're not 2026. So I'd say take about 23% off. So maybe around 20 billion, 19 and a half, 20 billion, 20 trillion is where Indians had invested it. They would have about 19 or 20 trillion. And so then, you ask, well, would the 19 or 20 trillion be more than undeveloped land in Manhattan? So the entire wealth of the United States, every man, woman, and child, everything we have, is about 150 trillion. So it's unlikely that just undeveloped land in Manhattan would be 1/8 of that. That's not likely. We've got plenty of other things in the country. And there's another way to kind of do this. Basically, Manhattan is about 626 square miles. And when you convert that to square feet, you basically, today, if you were buying pretty prime land in Manhattan, you'd pay about $1,000 a square foot for it. And this works out to something like 32,000 a square foot. So basically, the Indians got overpaid at $24, okay? And the screw up was that they didn't invest it properly.